Good evening and welcome back to iBankerU News Tonight. This is a second special report, and this is a feature we've been working on, but the silver markets have just been so volatile that it's frankly dominated everything we talked about. We didn't originally want to become a full-on silver channel when we started issuing reports, but it's just been such a developing story. But this is related, and so this is a good time to release this one too, something I've had for probably about a week now. So I hope it's worth your time. I hope you'll enjoy this. Please like, comment, and subscribe if it is. And tell us how we can improve if we just haven't hit the mark quite the way we need to. With that, let's jump into it. Something unusual is happening in the global financial system. You can feel it even if you don't know the jargon. Prices don't behave the way they used to. Assets don't trade the way they used to. And the institutions that are supposed to keep things stable, central banks, treasuries, multilateral lenders, are acting in ways that don't quite line up with the story they're telling us, the public. So let's start with something concrete, central banks. For decades, central banks told us that gold was a barbarous relic, that fiat currency, managed by enlightened technocrats using interest rate policy, open market operations, and inflation targeting was the future. Gold was inert, non-yielding, inefficient. And yet, quietly, persistently, central banks around the world have been accumulating precious physical metals at the fastest pace in modern history. The People's Bank of China, the Central Bank of Russia, the Reserve Bank of India, even smaller monetary authorities across the global south. Ton after ton of gold moving from the market into sovereign vaults, but why? If fiat money is stable, if inflation is transitory, if the current system is sustainable, why are the very institutions that issue currency choosing to store wealth in something they cannot print? That's not a philosophical question. It's a balance sheet question. Gold is a Tier 1 asset under Basel III. It carries no counterparty risk. It is not someone else's liability. It doesn't depend on the solvency of a clearinghouse, a custodian bank, or a derivatives exchange. When central banks buy gold, they are reducing exposure to the dollar-based settlement system, the U.S. Treasuries, and to the euro-dollar market that has underpinned global trade since the Bretton Woods collapsed. Which raises the next question. What are they preparing for? Because at the same time central banks are hoarding hard assets, they're also experimenting with the most abstract form of money ever conceived, central bank digital currencies, or CBDCs. Those are not cryptocurrencies in the way Bitcoin is a cryptocurrency. There is no decentralization, no permissionless ledger. A CBDC is a direct liability of the central bank, programmable, traceable, and fully integrated into the banking system's compliance architecture, like Know Your Customer, KYC, anti-money laundering, or AML, and sanctions enforcement, the real-time surveillance. In other words, absolute monetary visibility. So why does a system that claims to value transparency and efficiency need gold on one hand and programmable digital money on the other? Because those two things solve different problems. Gold is about trust between states. CBDCs are about control within states. Got that? A digital currency allows negative interest rates, that means it costs you money, to be enforced rather than suggested. You pay them to have it, they no longer pay you. It allows stimulus to be targeted, time limited, and revoked. It allows capital controls to be applied instantly. It collapses the distance between fiscal possibility and monetary policy, turning money itself into a policy instrument rather than a neutral medium of exchange. And once money becomes programmable, behavior becomes measurable. That's where the conversation inevitably turns uncomfortable, because around the world, particularly in technocratic policy circles, you increasingly hear about the same language: incentives, compliance, financial inclusion, risk scoring. Social credit isn't always called social credit. Sometimes it's ESG. Sometimes it's climate risk. Sometimes it's financial stability metrics. Sometimes it's misinformation resilience. But the architecture is the same: data aggregation, behavior modeling, and conditional access to economic life. Let that sink in. Now, zoom out. At the same time this infrastructure is being built, asset prices have exploded. Equities, real estate, private credit, fine art, collectibles, everything that already belonged to people with capital inflated dramatically. Driven by decades of zero interest rate policy, quantitative easing, and balance sheet expansion by the Federal Reserve, the ECB, and the Bank of Japan. This wasn't an accident. It was the transmission mechanism. When central banks suppress yields, capital flows outwards along risk curves. It bids up assets, it rewards leverage, it punishes savings. And it creates the illusion of prosperity until you try to buy groceries or insurance or housing or healthcare or anything else. That's when you discover that inflation isn't evenly distributed. Asset inflation benefits those who own assets. Consumer inflation punishes those who work for wages. And monetary inflation, expansion of the money supply, always reaches financial institutions first. Primary dealers, systemically important banks, shadow banking entities, private equity, hedge funds. By the time it reaches the real economy, purchasing power has already been diluted. So when people notice that they're working more and owning less, that their dollars buy less every year, that their children are priced out of the same life they had, it's not a mystery. It's the logical outcome of a system where money is created through debt, allocated through financial intermediaries, and stabilized through asset appreciation rather than wage growth. And now the system is wobbling. Debt to GDP ratios are historically high. Sovereign bond markets are increasingly sensitive to inflation expectations. The dollar remains dominant, kind of, but trust in its long-term purchasing power is no longer universal. Hence, bilateral trade agreements demonetized or denominated in local currencies. Hence, commodity-backed settlement discussions. Hence, gold. This isn't about apocalypse. It's about transition. The question is, a transition to what? A multipolar monetary system? Possibly. A bifurcation between hard settlement assets and soft transactional currencies? Maybe. A world where money is simultaneously more controlled at the individual level and less trusted at the sovereign level? That seems increasingly plausible. So when you see central banks buying gold, experimenting with digital currencies, talking about climate-adjusted capital requirements, and quietly tolerating persistent inflation, you shouldn't ask yourself whether these events are connected. They are. The reason is whether the people living inside the system are being prepared for the consequences or simply manage through them. Because monetary systems don't collapse overnight. They erode, gradually, technically, behind acronyms and policy papers and emergency facilities that become permanent. And by the time the average person realizes what's changed, the rules are already different. At least that's usually how it works. Thanks for watching all the way into the end. If we've earned it, please consider liking, subscribing, sharing, or leaving us a comment on what you think comes next. In the meantime, take care of yourselves and each other.